Good. So this is question 23 of April. So question 23. Sorry, what is not happening? This thing. So this is question 23 of April 2023. Yes. April 2023. That is the question. So let's go through the question. All of us. Mine is soft, so I'll be using my phone. It says, the following draft financial statement relates to H Limited and its investment companies S and A for the year ended 31st December 2022. So H Limited, S Limited, and A Limited, we have, so that is the balance sheet in short, the statement of financial position. Let's go to the additional information. The following details relates to the acquisitions. Company being acquired, they acquired S and A. Dates of acquisition. Someone will tell me, there is a way my phone has not captured the dates properly. 1st January of 20, which 20? And also the other one, the two dates. 20 what and 20 what? Somebody to tell me there.
20.
Which for S is 20?
2019.
Somebody?
S is 2019.
Dates of acquisition.
S is 1st
S was
January.
acquired on 1st January 20 when?
19.
My
20.
mind is not clear. That is what I'm asking.
Oh.
I don't know what is the problem. I don't know whether someone is talking and I can't hear. You can chat.
For us, it's 2019. 1st January 2019.
2019 and 2020.
Yeah.
Thank you.
Yes.
So that is 2019 and 2020. 2019 and 2020. Okay. We proceed. Cost of investment. Cost of investment is what we call purchase consideration. Then we have retained profits, then percentages. So as they acquired 80%, 80% qualifies as to be a subsidiary. 30% qualifies A to be an associate. H Limited also invested in shillings 25 million of the loan stock in S on 1st January 2021. No problem. On the dates of the acquisition, the value of the buildings in S and A were 50 million and 25 million above their carrying amounts. That is what we call fair value uplift, or people can treat it as revaluation, no problem. Buildings are depreciated at the rate of 2% per annum on reducing balance. The fair value of the non-controlling interest, that is the purchase consideration, can be estimated from the share price of S Limited, that was shillings 80 on 1st January 2019. No problem.
Mwalimu.
On 1st January 2021, H sold S Limited an item of land at a selling price of 75 million, reporting a profit markup of 50%. Plant is depreciated at 20% per annum on reducing balance. During the year, the company is traded as follows. S sold goods at a selling price of 20 million to H Limited at a normal gross profit margin. Now, when I read this question last, I detected there was a mistake. There was a mistake in that sentence, and maybe some of you who have read it have also noted there was something missing in that note, which is going to make, but it's not a big issue. If there's a mistake, there's no big issue. The concept will be home. In note 3.1, they are saying S sold goods at a selling price of 20 million to hedge at a normal gross profit margin. 1/4 of these goods remained unsold at the year end. You know, that one is supposed to help us get the unrealized profit on stock or unrealized profit on inventory. But now, as we continue reading, you'll realize they have not given us any profit margin of S because they're saying at normal profit, they have said at normal profit margin. But when you continue reading, you realize there is no Jared, there's a problem with the share price. What do you mean?
Yeah, on the fair value of NCI.
Jared, share price here. What do you mean?
The share price of S Limited at acquisition. Huh?
I think my volume of the computer, I need to check something. So maybe today we chat. Jared, you are saying there's a problem with the share price. Share price here means, maybe you elaborate. So I was saying in 3.1, there's a mistake because they are saying at a normal markup, normal gross profit margin. But as we continue reading, you will realize there is no profit margin which was given before. So we'll see how to go about it. Jared, the share price at acquisition of S Limited can't be shillings 80. I think it is 8. No, that one I also noted, but I assumed that 80, this was in note number, where is it?
Note number 1.
That 80, we assume is the total value, the total amount of the minority. So the one price there is what was confusing, but the total value of minority will be considered to be 80, but they did not capture it properly. We continue reading, note 3.2. Hedge sold goods at a selling price of shillings 40 to A, that is associate, reporting a profit of 10 million. Half of the goods sold to A had been sold by the end of the year. So that one is okay. At the beginning of the year, Hedge had goods to the value of 10 million purchased from S in the year ended 31st December 2021. Included in the trade receivables and payables of each the respective companies are the following intercompany balances. So due from Hedge to S, A to Hedge, there. A close check in S Limited's books revealed that receivables of S had shillings 30 million due from Hedge. This amount arose because Hedge sent a check of 5 million to S Limited on 29th December 2022, but had not received by S Limited as at 31st December 2022. That is what we call cash in transit. Meanwhile, all the companies have their interest on loan stock by the end of the year unpaid. Goodwill where relevant had been impaired by 20% on cost at the beginning of 2022. An additional impairment of 20% of the initial cost was again reported in the year 2022. So, prepare the consolidated statement of financial position. So now, during consolidation, for A Limited, an associate, when you get associate or joint arrangement is a joint venture or a joint operation at 50%, you only take their investment. So we will not capture their investment. The items, assets, liabilities of A will not be consolidated for. We only consolidate for an entity where you have 51% and above, unless you go for the exemptions, which I gave you some small notes, where they are appointing majority of the board and the rest, which is not in this case. So what I want us to do there is a mistake somewhere which I've noted, but that one cannot make us not do the question. So I want us to do what is called a skeleton statement of financial position. Then we see what happens. So skeleton means how the consolidated financial balance sheet should look like. Then we can come and fill what is necessary. So let's write that heading. And this is, and I say, in case someone was not there, workings are allowed in the same page. So there is no need of opening Excel 2. Your interlinking should just be within the same page. So you write here H group. So H group, consolidated statement of financial position. Statement of financial position as at. So this was as when 31st December 2022. That one should be not be there, should be somehow centered somewhere there, not a must. Then I can have that one underlined. Up to there. So we shall have only one column, shillings in, I've seen shillings are in thousands. So shillings, and this is how you will do your presentation in exam, kindly. So shillings here are in thousands. Let's just have one column. So the skeleton, I want you to check the way it's appearing there. We give those items the way they are, then we come and fill in where necessary. In which case, you will find some are not requiring workings. So that the ones which doesn't require adjustments, you just post them. The ones which doesn't require adjustments, you just capture them very fast. So non-current assets, non-current assets, non-current assets, non-current assets, property, plant, and equipment, property, plant, and equipment, Let's just go the right way because mtiani mtakuwa na shortcut. Intangible assets, then we have investments. So investments, itakuwa hivi, you will have investment in associate. So associate will appear here once. Associate, then you will have for S you don't bring their investment, you will replace investment in S with goodwill. Then if there is any value which will remain, we shall call it other investments, like that. Yeah, so with that, I've captured non-current assets comfortably. Then I will have that one there. Then I go to current assets. So current assets. We have which ones? Let's have that skeleton, and that is what you should do in exam. Just have that skeleton first. It will make your work easier. Inventory. So we have inventory. followed by trade receivables, trade receivables, trade receivables. Then we have cash at bank, cash at bank. Then we have, so that one we'll have it there. We shall have total assets at that stage. So here, we're going to have total assets. We don't have any option but to comply with this. So total assets there. Then equity and liabilities. We bring here equity and liabilities. Equity and liabilities. So equity and liabilities, we start with equity. We start with equity components, the ordinary share capital and the rest. So we will have here ordinary shares. So we have ordinary share capital, ordinary share capital. They followed it with retained profit, retained profit, retained profit. So after retained profit, they had, so when you add there, you will get what is called shareholders funds, shareholders funds. Then after which you will bring non-controlling. That is not there, but it will come. Non-controlling interest, NCI. Non-controlling interest and controlling interest. NCI, that will be a working, which will come later. Then we shall have total equity at that stage. Then non-current liabilities, non-current liabilities. Non-current liabilities. Non-current liabilities. We are going to have here the 10% loan stock. This is 10% loan stock. 10% loan stock. 10% loan stock. Then current liabilities. Current liabilities. Current liabilities. Current liabilities. So for current liabilities there, let's list them very fast. So we have trade payables, bank overdraft. So trade payables, bank overdraft, bank overdraft. Then we have current tax. We have current tax. So after which, what you will get here is now the total equity and liabilities. Total equity, and liabilities. Total equity and liabilities. Perfect. So just wanted to save my work. It's good to save these things. Anything can happen. So we don't want to start from nowhere. Yeah, so I've saved that work, which is okay now. So what I will advocate for, is that my students, let me enlarge this. I don't need this space. Yeah, let me make this one wide. So what I will advocate for, start with items which don't require adjustments. It will make your work easier, kindly. So let's start with those which are not, because there are so many things here which requires adjustments. So let's go for the ones which do not require adjustments. But before that, you can have your work formulated. You can have your work formulated. So formulated means here, I will need the total of all the assets. So this one will be is equals to the sum, so that we don't waste time adding, the sum of here from property, we drag it up to that stage. So that one has already been formulated. Then total assets will be equals to the sum of from this one here, from this 0 here, all the way to there. That has also been formulated. Then shareholders funds is equals to these two. Those ones I can just add manually there. Those two will give us the shareholders funds. Then this total here, but this one was not supposed to be bottom double lined, so I need to do a rectification there. Here we just bring this with the single. It should just be single so that it doesn't close for the other one. Maybe that. Oh, what's that? Whichever way, that is something which should not disturb us. So the total of shareholders funds plus this non-controlling, I'll bring it here. Or what I can do is simple. Instead of disturbing myself, I can reduce this one here. So here, then the bottom line should be here. So the sum of those two will give us the total equity. So it is this shareholders funds, this one here, plus non-controlling interest. Then loan stock total here will be is equals to the sum of all this from equity, this one here, we bring it up to current tax. So sometimes it's good, first of all, to formulate your work that way. It will give you easy work. So there are some you just need to post. You just need to post without workings. When you're dealing with consolidated balance sheet, start with start with ordinary share capital and share premium if share premium is there. You only take for the parent. In any group accounting, we only take the shares of the parent. So in this case, parent never gave out other shares. So just go to the balance sheet and pick the retained earnings of the parent. So this is 2 million. I hope you can be able to see that. It is 2 million. 2 million. And also, the best I could have done, I would have ensured that this space, I do that, but I reduce the zeros. I don't need those zeros like that. So that is 2 million for the ordinary share capital. We have the 2 million there. So it is inakuja zikiwa mingi huko chini because already we have the formula. So as we put, it will be adjusting. So we are looking for the ones which do not require workings. I want them to come from your side. Can you tell me the ones you think there is no workings we require? I can see some, but just to make the class live, we have to participate. Which ones are you seeing? They don't require any working, any form of working at all. Is there any? I think
Cash at bank.
let me see. Jared says current tax and
Cash
bank
at bank.
overdrafts. So current tax, you will we will add the two, but now you cannot add straight from there. You must do that outside working. So bank overdraft is the one which does not require any addition. Bank overdraft does not require any addition. So to that effect, you will come here and say bank overdraft. Our bank overdraft was only appearing in S. Remember, the items we are bringing into consideration are H and S. So when you check the bank overdraft for H was 0, then for the subsidiary, you can be able to see 37,500. So that is what we are going to capture there, 37,500 there. Then current tax, there is no much workings, but we can make it our working one here. So we say there, working one, you say current tax. So current tax. You don't have to be very official there. You just say current tax is equals to how much? 25,000 plus 40. I hope you can be able to see. So we are not consolidating for A. So that is 25 plus 40 plus 40,000. So we have 65. And 65 is what you bring up here. So you come here and say is equals to, you link it with this 65 here. So you just click 65, it's equals to that 65, like that. You continue saving your work as time goes. Then something else which can be easier for us. I want the class to be interactive. Which other element are you seeing which can be easy, which will not require much workings? There are some which are terrible when it comes to workings. So I want you to tell me. The other one being proposed here, intangible assets. Yeah, the intangible assets, there is no much working. It's just the additions of the two. There is nothing serious about it. So you can just come and say working number 2, intangible assets. So intangible assets will be 50 plus 5, will be 50 plus 5, which is 55,000, So that 55 is what you link up there. So you'll come here and say intangibles is equals to, you bring this one here. You just click, then you enter. So you have there 55. Continue saving your work. Another one, there is some, I can still see, there are some which doesn't require much workings. Which other ones are these? Which one are you seeing which does not require much workings? Jared, cash at bank. Yeah, cash at bank, there's a small adjustment. There was cash in transit. So remember to adjust for that cash in transit. So our working number 3, there is cash at bank. So this is cash. So cash will be is equals to 100,000. Let me see if this space can be. You don't go to. Let me see if this space I can make it. I don't like working without these 2 commas. I don't know, not a must, but I just like working because I can over capture the number of zeros to bring problems. So cash at bank will be 100,000, will be 100,000, 1, 2, 3, plus nothing. There is nothing for subsidiary, but there was cash in transit. Remember, cash in transit, check note number 4. Let's go to additional information number 4. They said, so you only work with the H to S. The amount due was 25, but they said a close check in S books revealed that the receivable of S had 30 million due from H. This anomaly arose because H had sent a check of 5 million. So that 5 million is the cash in transit. Cash in transit is CIT, abbreviation for cash in transit, CIT, cash in transit. So it means in total, we don't have to disturb ourselves. That is 105. 100 plus 5, that is 105. 1, 2, 3. So that is 105,000. So that is what you take under cash. You don't take it here manually, please. Cash, you have to interlink it by saying is equals to, don't capture manually, is equals to this one here. Then you enter. You enter, then always remember to save your work. Good. Any other? I will go with you until now we get to terrible things there. Which any other can move? Let me see. Yeah, there are some which can still move. I'm seeing like 2 there. Jared, you are saying loan stock. Yeah, loan stock will move because what you will do, check working for. Check working for. So for the working for, you will take 10% loan stock. So the 10% loan stock, 10% loan stock will be, loan stock students will be 100 plus 75 plus 75, but minus, remember somewhere there was intercompany loan stock. Check the small note in note 1, approaching your note 1. There is something they said that H also invested in 25 million of the loan stock in S. So that 25 should be eliminated in the loan stock. So minus 25. 25 is intercompany loan stock. That 25 is intercompany loan stock, which now will be, is going to be 100,000 plus the 75,000 minus 25. minus 25,000. So you get the correct loan stock should be 150,000. So you go there and say is equals to, where's the loan stock? It is here. So is equals to, you come and click this figure here. You enter like that. Correct. It is now my opinion that we go for receivables. So working 5, let's check receivables. Receivables and payables at the same time. Receivables and payables. So working 5, we talk of trade receivables. Here is just working. Don't waste your time with the word trade. You'll be wasting time. So receivables, I will consider adding 175,000 plus 70 minus the correct intergroup balance down there in note number 4. In note 4, the correct group balance. Don't subtract for associates. Subtract for parent and subsidiary. Yeah, we'll go to payables as well. So subtract the intergroup balance between parent and subsidiary. So that is 25. Then you subtract also cash in transit. Cash in transit was 5. So you subtract all of them, both cash in transit and the correct balance. So the intergroup balance is 25, but there was cash in transit. You know, when cash in transit, you should not tell these people to pay. So you'll take 175 plus the 70. Is that 70? Yes. Plus the 70 minus 30. 25 and 5, that is 30. So the correct amount should be 215. So 215 is what you take up here. You don't have to capture it manually. So you just press is equals to, then you click this one, then you enter like that. So good. I hope we are moving on well. Then payables can also be worked out very fast. So that is our working number 6 for payables. So payables will be, let me see the figures. Let me see the figures here. Payables will be 350 plus 100. 350 plus 100. I hope that is 100. Yes. 350 plus 100 minus the intergroup balance, that 25 in note 4. You subtract it both from receivables and payables, but cash in transit you don't bring here. So it will be 350. It will be 350. I'm sorry. Is equals to 350 plus 100 minus 25. Minus 25. So you get 425. So payables is here. You just say is equals to this one here. Then you enter. So from the looks, all the current liabilities have been captured. Yeah. That is good. Something else. Inventory because they messed up. There is a problem in that inventory because of unrealized profit. I want things which are not going to give me headache. So allow me to save my work. So now I will not have any option now, but to check PPE, property, plant and equipment working. So working number 7. So working 7 will be PPE, property, plant and equipment. property, plant, and equipment. This one is now serious working. So you'll have H limited. Sorry, H limited. You will also have S limited. S limited also there. Bring those figures. Bring the figures. So here for H we have 2,110,000. Then this other one we have 902,500. Then there was revaluation. There was revaluation. Check note number. Which note is this? Before note 2. No. Yes. Yeah, so you come here and say, fair value uplift, which will be recognized as revaluation. Only for S, we go for S. On the date of acquisition, the value of building in S and A, 50. So I'll go only for S. So I need to be categorical for S. This one was 50. So I will consider there 50. Then there was depreciation on fair value uplift. So depreciation will be on the fair. So depreciation on the fair value, to be categorical, will be, they said, the useful life about their fair value carrying amount. Buildings are depreciated at the rate of 2% per annum. 2% per annum on reducing. So we are in which year? We are in 31st December. These people, they are making our life difficult. In fact, they are making our lives very, very difficult. 2019, 20, 21, 22, 4 years. You don't know why they are making our life difficult here. They are saying that buildings are depreciated at 2% per annum on reducing balance. So hii lazima tuiweke hapa kando. So let's do depreciation. Depreciation on buildings. Buildings S limited. So you will carry out depreciation for 2019. It was acquired in 2019. S was acquired in 2019. So I have to get accumulated depreciation because S was acquired in 2019. Yes, Jared. That is why I noted. So then 2020, 2021, 2022, they should not have those commas like that. That's not a big issue. So in year 1, first year, it is 2%. Remember, it is 2%. So 2% is equals to 0.02 times 50. The value was 50. So that one should give you, is equals to 0.02 times 50. I think that is okay. Times 50,000. So that was perfect. 1,000 year 1. In year 2, you will take 50 minus the 1,000 is when you charge. So that will be 50 minus 1,000 is 49. Let's not waste time with unnecessary issues here. So it's equals to 0.02 times 49,000. That is 980. So up to date, you have charged depreciation of 1980. So the next year you will say, let me see what is remaining. so that I bring it there. Initial was 50 minus 1980. We have charged so far 1980. So we are remaining with that figure. So you take 0.02 by 48,020. You get that figure there. Then finally, in the last year, you will still take 50 minus what you have charged to date. You have charged this, you have charged this one here. Whichever way you follow, you have charged this one as well. So the remaining value to be depreciated, who told them to bring reducing here? 47,059.6 times 0.2. You get that figure there. So the total accumulated depreciation, is that figure there. Is that figure which you can see with your eyes. That is the depreciation value, the accumulated. So I'll bring it here. Though I will subtract, it should be subtracted 3881.59. Let's just bring it, or let's work with one decimal. Yeah, 0.6. So that is that. Then there was another one. PP is not over. There's another concern coming up. There's another concern in note 2. On 1st January, H sold as an item of plant at a selling price of 75, reporting a profit markup of 50%. Plant is depreciated at 20% per annum on reducing again. So here we will also less. You need to less what we call UPFA. Less UPFA. UPFA is the unrealized profit on fixed assets. So it will be, they sold at 75. So it is 75, 1, 2, 3, by profit margin. They gave us markup. Markup, they gave us 50%. So if markup is 50%, it means margin will be 50% is 50 over 100. So which is a half. So margin will be 1 over 3. I hope you know how to convert that. So unrealized profit will be 75 times a third, because 50 is 50 over 100. So margin will be 50 over 150, which is a third. So this one will be, what will that be? 75,000 divided by 3, you get 15. I hope that is divided by 3. That is 25. So here you need to subtract that unrealized profit of 25,000. The unrealized profit is 25. Good. Then you add back. These people were charging depreciation on that profit. You are not supposed to depreciate profits. So you add back the excess depreciation. But that is the last. You add back excess depreciation. Sorry, you add back excess depreciation. So excess depreciation, again, you see they're using reducing balance, 20% reducing balance. That is what they say. Yeah, 20%, 4 years. So excess depreciation, we don't have options. Excess depreciation, they are charging 20% per annum every year. So 2019, yes, someone is saying it is 2 years. How? It was sold when? On 1st January or 2021. So it's 2021, 2022. So that is good. It was sold in 2021. So that one is going to make our work a little bit easier. 2022. Yes. So on reducing, so it means year one, excess you multiply based on the UPFA. This profit is what we don't want. So you will say 25,000, it is 25 times 20% year one. So 20% year one, you get 5,000. So you will take 20,000 minus 5, you depreciate the remaining 20. So in year two, you will take 20 times that, which is 4. So total excess depreciation, which should be added back, should be the sum of these two, which is just that is 9. So that is 9,000. So 9 is what you need to bring here. 9 is what you're supposed to take up there. Continue saving your work. So excess depreciation is that 9,000. Excess arises on the unrealized profits. So that is the one you are supposed to adjust. So for property, plant, and equipment, that is all. I've not bothered with associates, so only take into consideration that one there. So this one will be the sum of all this, all that one there, then you enter. So that is the value of PPE to be taken to consolidation. Unless you have a question, I'm posting that to the balance sheet. I'm going to post that to the balance sheet. It seems no concern. So PPE is equals to this figure. You take that figure. So that one is what you enter up there. That's what you enter up there. I want us to calculate which one will move. I want the things which can move very fast. Investments. This one here, other investments. I want us to determine other investments. Yeah, Jared, other investments can move. So let's have, it's not a must you proceed down here. The workings, you can concentrate them here. Besides, Apo Kando, you can bring them here. Some can even come somewhere here. There is no problem. So I want to bring some working somewhere here. I will call it working 8. So working 8, other investments. So other investments. So for H, S, so you take, first of all, you just take the investments the way they are. Take the investments the way they are. Under non-current assets, check non-current assets. Check non-current assets. Investments total, we are having 11, 25, 1, 2, 3. Then S, we are having 10, 1, 2, 3. So we have the 10. But now you need to less. You need to less what parent invested in the subsidiaries. So less investments in. So let me push this one here, like a good presentation. So less investments in, full column, down there, in S and A. These two can move to the corner, so I can bring them there. So investment in S and A, whatever you invested in your subsidiary and associates, they're included there. Parents should eliminate them. So check note 1, cost of investment. In A, parent invested 750. 750 there. In A, they invested 300. Those ones will go to goodwill computation, so you have to subtract them. Then also, you need to less investment in loan stock. Less loan stock investment in loan stock. So they invested in loan stock of S. So when you invest in loan stock, also you need to subtract. So that investment in loan stock was, how much was it? It was down there, 25. It was 25,000. So that investment in loan stock, that one also should be subtracted. So the other investments which are remaining should be, the remaining investments should be the sum of this there. Close it, enter. So that is 60. That is 60. So other investments should be 60. So is equals to this one here. Like that. Which one can I? You know, inventory could have moved, but now inventory, let's do goodwill. We don't have any option, but to do goodwill will work. Yeah. Let's work out goodwill. Let's go for goodwill. I want a good space for goodwill. I want a good space for goodwill computation. So goodwill, I can do goodwill here. And call it working line. Can call it working line. My working line for goodwill computation. So goodwill. So goodwill, I want us to calculate goodwill for the two entities, both of them. So both S and A. So I will have here S, and I will have the other side A. So to calculate goodwill, you start with the consideration. Consideration paid. That is the investment. So check those considerations in note 1. The 750 and the 300. So here there is 750. Here we have 300. I hope you can see them. Then there was fair value of NCI. Fair value of NCI, non-controlling interest. Jared, the one which is you are talking about in the note before note 2, the fair value of the non-controlling interest purchase consideration can be estimated from the share price of S Limited. Share price of S Limited, that was shillings 80. That's how. But now we will just have to comply. Jared, we cannot assume what you are saying that it is 8. We'll just comply with what they have said. We'll just comply with what they have said. So complying with what they have said, the share price was 80. Then I will take fair value of minority to be 20% because parent had acquired 80. So minority, I will take 20%. The share price of the subsidiary, they are saying shillings 80. It was 80 on that date. Then I multiply with the number of shares. So the number of shares in S, you will take 500,000 divided by 5. You take 500,000, divide by 5, which is par value, to get the number of shares. So it will be 50, like that. So that will be the value of the minority here. So it will be 50 times 80. So is equals to 50 times 80 times 20%. So the value of minority, as you guys can see there, they are saying it was supposed to be, these things are time wasting. It is 800. So they have more than even the parents. Yeah, I think that is why you are saying this thing is not making sense. They cannot have more than the parents. Minority, because that one comes to 800. That is not practically, impossible. I think the examiner messed there. It cannot be. Minority cannot have that much. It should be trading at 8. Please, let's just use 8. The examiner nikosea hapo. Let's just use 8. Tutaambia examiner wache hiyo makosa ndogo ndogo. So here let's use 8 instead. Let us use 8 instead. Equate 80,000. So this one is supposed to be 8. They messed in 2 things. That was one, and even unrealized profit, there is a problem. So now, we have this. So total consideration, you add with the NCI, and this one here, for associate, we have that. Then you less net assets acquired. So less net assets, less net assets. Net assets is going to be, you take ordinary share capital plus retained earnings plus revaluation.
Mwalimu is supposed to be 160,000. Fair value of
NCI. Let me check it
NCI.
this way. Start with retained earnings. So no, with ordinary share capital, retained earnings. Then there was revaluation on the dates of acquisition. You subtract those ones.
Mwalimu.
So go to the balance sheet. Ordinary shares of S was 500. So this is 500. 1, 2, 3. Then for A we have 400. Huh? Yeah, A is okay. A we have 400. But for A, you know, this one is not going to be apportioned. S you don't apportion because S already, once you add minority, ukishaweka minority, it simply means that it is full. It's now 100. 20% plus parent 80 is 100. So you don't apportion these ones. But for the associates, you will be taking 40%. 30. It was 30%. We acquired 30%. So net assets will be apportioning with 30. You'll be taking 30%. Sorry. So this was 500. Then here, you will be taking 30% of all the net assets. So this is 30% of 400. There, that is 120, but it should be negative, sorry. It should be negative so that we subtract 400 times, that is 40, 400 times 30. All right. Why are you disturbing elders here? People are having concerns. Ni nini hapo juu? Just a minute, Jared. Iangalia what you are saying. So this one should be 30% is equals 30% times the 400. 1, 2, 3. That is 120. Then Jared, let me check what you are saying. Let me check what you're saying. Fair value of NCI, 0.2 times 100 times shillings 8. Where? What was our multiplication? Let me check. 500 divided by 5 is 100. Sure, that is true. What did we take? Oh, divided by, yeah, sure. I hope you have seen what Jared is saying here. We took the 500, I divided by 10. It is 500 divided by power value, which is 5, which comes to 100. I agree. So this is 100 here. It should be 100, but we are still okay. So that is 100. So here should be 0.2 by 8 by 100. 1, 2, 3, 4. That is 160, correct. Then you subtract this one here, the ordinary share capital, which is 500,000. This one was to be in brackets, 500,000. Enter there. Then retained earnings, you check on the date of acquisition. Goodwill is computed on the date of acquisition. So check the retained earnings on acquisition. Uko chini, not 1, 200 and 300. So you will subtract 200,000. But this side, you take 30%. This one you must apportion. So you take 30% times 300,000. Times 300,000. But now this was supposed to be, it's supposed to be a negative figure. So we have to have it in brackets. Why? 0.3 times minus the 300,000. Yes, like that. Then revaluation, finally, revaluation is the fair value uplift. Revaluation is the fair value uplift, which in note 1, paragraph 2, this one was 50, the other one was 25. So you will subtract 50. There was fair value uplift of 50,000. The other one, make sure you multiply with 30% of 25,000. Yes, you get that figure. 30% of 25 inakuja hivyo. 30% of 25,000.
No, 70.
Yes, iko hivyo. It's wrong. Is equals to 30% times 25,000. Did I capture the correct thing? 75. Yes, that should be 75. True. Good. So this will be our goodwill. So goodwill in this case will be is equals, hey, I'm not supposed to bottom double underline. I should just have single bottom line there. So goodwill is going to be the sum of all this up to this stage. You enter, then you can bring this other one, this side. Then impairment. So this is goodwill. Goodwill. That is the goodwill on acquisition. That is the goodwill on acquisition. Then there was a story on impairment. There was a story on impairment in note number, check note number 5. Okay, note 5. Goodwill, where relevant, had been impaired by 20% on cost at the beginning of the year 2022. By the beginning, that is called accumulated. So less accumulated impairments. Accumulated impairments. Accumulated impairment. So accumulated impairment will be in bracket 20%. 20%, so it is 20% each. They have said 20% on costs. So 20%, why are you becoming negative? So 20%, you will take 20%, this times 20%. We should be also the same to this other side. So those are the 20%. Then again, they are moving forward to say an additional impairment of 20% of the initial cost was again reported in the year 2022. So this was accumulated, then impairment for the year, less impairment for 2022. So 2022, again, they have said 20% of the initial costs. Also, understand two stretch. So 20% again, so it will just be the same. The initial is just this one, so it's still the same thing. So Angesema once, that thing has been impaired by, but let's just do it the way they have said. We don't have any option. So therefore, the net goodwill will be now the sum. Net goodwill will be the sum of this. You need to subtract minus that one there, like that. So those are our goodwills. But now, for A, we don't take the goodwill of associate there. The only goodwill we take is for subsidiary, the 96. So you will go to the subsidiary, you will humble yourself, you go to the subsidiary, goodwill is equals to, now look for that goodwill of yours, you link them up, this 96. That 96 there. So for non-current assets, we are remaining with investment in associates. So I want us to work out investment in associates right away, which without fear I can do it here as working 10. Whatever you do, your working is not a big issue. Working 10, investment in associates. Investment in associates. So you say initial investment, initial investment in associates was how much? Check the amount we invested there. Actually, it is here. There is no need of wasting time. When we are calculating goodwill, this 300, so is equals to this 300 here. It is that 300. Then you add post-acquisition profits. You add profit that company made after acquisition. So post-acquisition profits. So post-acquisition profits will be in brackets, no, will be 30% in brackets, the closing retained earnings. Check the closing retained earnings minus the retained earnings on the date of acquisition. So closing retained earnings in A, and that is how we calculate that. In A, the closing retained earnings is 470. Please check. So it is 470, 1, 2, 3, minus the retained earnings on the date of acquisition. Check the date of acquisition. You will realize the retained earnings was in A, it was 300,000. 300, 1, 2, 3. So that is the post-acquisition profit, which will be for 70 minus 300 is 170. So it's equals to 30% of 170 when you get that difference. So that is 51. Please be checking with me. Then you less impairment. There was impairment loss. That company has been impaired. Our investment has already been impaired by, so we can check them here, these two, 16.5, 16.5, that is 33,000. So has been impaired by 33,000. Or I can add them, but no need. 16.5, that is 33. So this is impairment, right? Something nice, impairment. Then also less unrealized profits. There was unrealized profits. Less unrealized profits. There's a lot of unnecessary work. Unrealized profits, there was unrealized profit in associates, I remember. I'm coming up with my own things. I think it was there. Check.
Yes.
Check 3, note 3.2. Note 3.2. Hedge sold goods at a selling price of 40 to A, reporting a profit of 10 million. So they reported a profit of 10 million. Half of the goods to A had been sold. So it means a half remained. So I need the unrealized profit. Unrealized profit will be 10 over 40. That is the profit margin because the profit was 10. So to get profit margin, you will consider 10 over 40 times a half. A half was never sold. So times a half times
40.
The total value of the goods is 40. I hope it will be sensible for you. You will take 10 over 40 is the profit margin. A half is what was not sold. So a half of the 40. So a half of 40 is what remained in the store. So it means it will be 10 over 40 is 0.25. So it's equals to 0.25 times a half is 0.5 times 40. So it means the unrealized profit, but I needed it as negative. So it's equals to 0.25. 10 over 40 is 0.25. Half is 0.5 times 40. Like that. What are you relating? Okay. How should it be? I should remove the equal sign here and put it outside, or what should it be? Will that work for me? I don't know. If it doesn't work, I will go the way I want. 5. So unrealized profit is 5, but kwa nini haileti hiyo negative? Unrealized profit in associate was 5. Therefore, the investment will be the initial cost plus post-acquisition profit. No, that is not correct. One thing remaining. There was depreciation. Awatu leo natufanyia ile maneno mbaya. Less depreciation. But even that unrealized profit,
Inafaa kwa 5,000.
parent needs to take 30% of it. Yes, but that one will come later. You are saying 5,000. Oh yeah, 5 because it is fine. So I'm coming there shortly. Just leave it. It's 5. Depreciation, we have to work it somewhere here. So where will I work the depreciation issue? Let me work it here. Depreciation, A limited. So let's work that depreciation. A was acquired in 2020. There was that fair value uplift. I've just remembered. There was the fair value uplift somewhere there in A 25, then 2% per annum. So it is 2020, 2021, 2022, like that. So depreciation is going to be based on the 25. So year one will be 25 by 2%. Year two, you take 25 minus that. So year two will be 24,500. 24,500 by 2% for 90. So last year will be, what is 25,000 minus all that? 25 minus these two, you are likely to get 24,010. So 24,010, but they were not supposed to bring reducing here, surely. So like that. So total depreciation there will be the sum of these three, 470. So depreciation here should be 1470. But now, you know, parent will only take 30%, even the unrealized. That's why I left unrealized. 30% times 1470. I hope 1470 is perfect. 1470, but now I needed it as negative, fine. So 441.06. 441.06. 441.06. That is how I wanted it to be. This one here also should be 30%. The unrealized profit, 30%. It was 5,000, but now negative. Why am I not capturing negative? Wait, is equals, sorry. Is equals to 30% times the 5,000. So that is 1,500. Therefore, the investment in associates should be this figure here. That's how markers work on a problem. The sum of all this. So you create that there. So investment in associates will be 316. Where is investment in associate? Here. So you bring here is equals to this one there. So we are done with all assets except inventory. But now inventory, I don't know how we'll maneuver, because there's something missing, or we'll just do a guesswork, because so we are only remaining with inventory, retained earnings, and NCI. So inventory is what is going to give us a challenge, because so let's see what happens. It's not bad to start. So this is inventory. So balance, no, not balance, got down. H, sorry. H and S only. H and S. So HS, inventory of H was how much? 300. So this was 300. This other one was 130. 130. You need just to subtract unrealized profits. So the unrealized profit is where I have a problem, because the examiner unrealized profit on inventory, UPI. Unrealized profit is where the examiner missed. Read here, note number 2. Read note 2. They say during the year, the company is traded as follows. S sold goods at a selling price of 20 to H at a normal gross profit margin. 1/4 of these goods remained unsold at the year end. So what is this normal profit margin? You know that's now the issue, because there is nowhere S had sold to H before to guarantee us to know the normal. So if I just try to reason with the head of the examiner, I might say maybe the way they had captured note 2, where H is the one who sold to S at a profit markup of 50%. So maybe the examiner was trying to imply that the group uses the 50% markup, then I can convert. Yes, Jared, that one is the one I'm saying. So me, I'm thinking that is the one which was in the head of the examiner, just assuming that it is that 50%. So we use 50 over the 150. So let's have that one on assumption. But examiner there hakukuwa fair kwetu. So we'll take 150 over 150 times 1/4 of these goods remained. So times 1/4 of those goods times the sale value. The sale value was 20 million. 20 million. Yes. Sale value was 20 million. So now, in computation, it will be this way. I want it as negative. So it will be is equal to 50 over 150 times 0.25 times 20 million is that 20,000, because we're working in thousands. 1, 2, 3. I hope that is okay. Now what is that? Yeah, that is it. That is how it is. But now I will reduce to 2 decimal. I will reduce this one. Reduce up. Yes. I can reduce it to 2 decimal places like that. Therefore, there was nothing on inventory. I will comfortably say that inventory is equals to this plus this plus this one here, so that we get that figure. I mean, that is what we have. Because sasa yeye akitusumbua hata yeye atajipanga. 428 343. Aya. So that is it. What is remaining? Kazi ni mingi sana. What is remaining here? We are remaining with retained earnings and non-controlling interest. Wacha nianze na non-controlling interest. NCI. So let's work with NCI. Let's work NCI, I mean. So fair value, fair value on acquisition. Fair value on acquisition. On acquisition, what I nitafute huko kwa goodwill, so that I don't, is equals to, I don't want to do a lot of workings here. Fair value of NCI on acquisition is this one here. This 160. So you have 160 there. Then, after having fair value on acquisition, you add what we call post-acquisition profits. So post-acquisition Post-acquisition profits. Post-acquisition profits will be 20%, sorry, will be 20% of the profit the company made after acquisition. So it is 20% in brackets. Check the closing retained earnings of S. The closing retained earnings of S. Retained earnings of S is 500. Really? Yeah. No, it's 365. So it is 365 minus the profit when we acquired this company. The profit when we acquired this company was 200. So minus 200 there. Let's start with that one. 365 minus 200, that should give us 165. So it's equals to 165, 123 by 20. You get 33. Then there was impairment. So less impairment loss, the total impairment, they will also take 20%. They will also take 20% of the impairment. So impairment, they will take 20% in brackets. Impairments are here, 32, 32. Actually, 32 plus 32. So that is going to be 20% times 64. Times 64, but I want, sorry, 20% times, I want it in negative 64 there. I will also subtract depreciation. So less depreciation. Depreciation will be 20% of depreciation is here, students. This one here. Hey, there was excess na kuna hii ingine.
Yeah,
so what we can do, you know, we're supposed to add 9, then we subtract this. So what we do is simple. We take 9 minus this one here, 3881.592. This one here, this and this. You know, this one is supposed to be subtracted. Excess is supposed to be added back. So it will be is equals to, so this one we are not subtracting. This one we are adding. We are going to add it because the addition is more than the subtraction. So what is the difference first? 9,000 minus 3881.5 whatever. 81.592 is, please confirm with me, that is 5118.408 by 20. So we add back that excess depreciation because the excess is 9, excess is supposed to be added back. Then this one is supposed to be subtracted. So I've netted the two. Kuna kitu ingine hapo inagonga NCI, there is nothing. So it will be the sum, one will belong, the sum of these ones here. So NCI takes that into consideration. So I will come and say, where's the NCI? NCI, non-controlling interest, is equals to, well, this one here. We enter. That is done. So we are only remaining. Whichever it brings. So we are only remaining with the retained earnings. So retained earnings. Example, I expect it to find hours. So retained earnings Sasa hapa ndio kizungu ile ninasemanga sijui kizungu gani. Retained earnings for H. For H, retained earnings, you take the balance in the balance sheet. The balances in the balance sheet, which retained earnings is 2 million. 2 million iko hivyo, I hope so. Yes. Then for these other two, S and A, post-acquisition. So post-acquisition, post-acquisition, post-acquisition profits. So post-acquisition profits for S will be 80%. You'll take 80%, check the closing retained earnings of S, 500,000 minus, on acquisition it was 200. So that is 300. So 80%, someone raising a concern, let me see. Steve, depreciation should be negative in working 11. I'm just checking right now, Steve. So this is going to be 80% times 300. 1, 2, 3. So that is the post. Watch and angalia what Steve has said, kindly. Depreciation in working 11. No, Steve, it should not be. You know what happened? This depreciation, there are two of them. Steve, check here. There is this one. There is excess. Excess should be added back because excess had understated the profits. So excess is supposed to be added. So we are supposed to add 9, then subtract 3. So the net effect, 9 minus 3 remains positive. So we are supposed to add. Steve, I hope you understand. You know 9 is supposed to be added because it's excess. Then we subtract this other one. Noted, good. So Jared, post-acquisition is 365 less 200. Let's check. Okay, so back to where we were. It was just what Steve was saying. So this is, you are saying it's not 500. Which figure is 500? Let me check. Retained earnings in the balance sheet is 365. Oh, I took ordinary. Thank you. So this is 365. So 365 minus 200. But I like the participation. So this is 365 times 80%. That is 292. Also for A you will do the same. For A, you will take 30%. I'll check. 30% in brackets. That one we did somewhere. So I'm going to pick that figure. For 70 minus acquisition, 300. We did it somewhere. So I'm not going to waste time here. But it is easy. It is just 30% of 170. 30% of 170. We got it somewhere. 51. Now the only problem we have, all those items which are affecting profit, we are many, but we don't have any option but to comply. So less impairment. The good thing we have most of them. So less impairment. So impairment for AS, impairment for S will be 80%, 80% in brackets. S impairment, where is the impairment for S? Impairment for S was coming to 64. 64. So you can say 32. So it is 80% of 64. 80% of 64, where that 64 should not just be like that, is equals to 80% times 64. I want it in negative there. Then for A, hata tulishapata. I don't want to waste time now. We have it. For A, where is investment in associates? A is this one here. A is this one. We've got to shapata mahali hapa. That one there, that 33. But how did we get the 33? Let me just confirm. It was, no. Wait. 16.5, 16.5. 16.5, it was 16.5, 16.5. This and this. So the impairment, we are not supposed to apportion because that is our value which has been lost. Yes, we don't apportion. Here it goes out. We take it the way it is. Then less unrealized profits, less UPI, less UPI. So UPI in S and UPI in A. So we have all of them. So just to check, those are where the inventory. In S, this one here. So let me bring it down here. In S is equals to, this one, that one. Then in A, where is investment in associates? UPI is this one here. Okay. The 1500. The 1500. Remember, this is the last working. We don't have time. We got 1500 initially. Then depreciation. So depreciation, I think depreciation should be our last issue. So depreciation in S and A. S and A. S and A. So let's see. Depreciation S, post-acquisition profit of S should be 132. Let's check. This, I hope you are referring to this. It was supposed to be, post-acquisition was supposed to be how much? Jared, what are you saying? It is supposed to be 365. 365 minus the 200, which is 165. So 165 by 80. 132. Is that what you are saying? Oh, sawa. That is computer error, not our error. That is computer error. Yeah, that is okay. That is when rectified. SAP. Depreciations. Let's bring them. Depreciation for S is this one here. We have two of them. Steve, the one you are saying, there is this and this. So we are supposed to take this minus this, then we add. But I will take 80%. So it is going to be 9,000 minus 3881.592. So I will subtract. So it is 80%. Let me show it. Hata kama time imeenda. Let's do the right thing. 80% into bracket 9,000 minus 3881.592. Like that. So with that, you're supposed to get is equals to Just a minute. People in the college are looking for me. Just a minute. I tell them I'm still in class. So is equals to 0.8 times, the difference is 5118408. That one. I'm finishing a class. I'm checking back. I'm finishing a class right now. I'm finishing a class. So I'm calling in 3 minutes. So that is that. Then for A, depreciation for A iko wapi? We have it somewhere. I don't want to waste time. Where is it? Depreciation is this one here. Depreciation for A, we had already taken the 30%. It was this one, yes. So 441.06. So that is what we bring here. For 41.06. I don't want to waste much time. As far as I'm concerned, that should be our retained earnings. So is equals to the sum of all this. The sum of all that. It can't be that way. There is a problem here. Hapa kwa depreciation of S. Depreciation of S, here there is an issue. Depreciation of S should be, it is 5, the difference is 5, this 0.408 by 80. Yes, so that should be the figure. So can we integrate it up there to the retained earnings? Even if it fails, I will not have problem because examiner alipotea pale kwa NCI, the shillings 80, and even UPI, we worked with assumption of 50, so it will not be a very big concern to us, but let's just bring it for the sake so that they can mark. So here we are getting total of 4.9. Here we have total of 4.3. It will not be a big concern to us because UPI and even minority, we are not sure of the figures which the examiner wanted. But ideally, out of the 20 marks, what the students were supposed to get, please, as we wind up, as we close, let me show you here. What you are supposed to get are these ones here. Current tax you are supposed to get. Current tax, you are supposed to get the bank overdraft. You are supposed to get payables. Those ticks, you are supposed to get ordinary. You are supposed to get the ordinary. You are supposed to get cash at bank. We are marking now cash at bank. You are supposed to get receivables. Inventory kona shida as per the examiner. Then up here, intangibles, there was no issue. Retained earnings for H, if you add, is 1385. Jared, hiyo umetoa wapi? The 1385. Where have you gotten that figure? Okay, if I assume 1385, which you are bringing, what will be the change? How will it change? Just assuming. Hiyo umetoa wapi? I choose ordinary shares instead of retained earnings. Oh, let me see. The 2 million. Ordinary. So it was supposed to be how much? You know, using the phone sometimes becomes challenging, but I can still check. The retained earnings of H is 1385. Oh, yeah. 1385. 1, 2, 3. Oh, yeah. Yeah, I've seen that. So it will make this one to go down to 1484. Okay. So this one will go down to 1484. 1484. 43,001. Still, we have a very small variation, very small. In fact, very small. 1385. We have a very small variation because we have 43,18,001, 011 minus 43,011. 25. There's a variation of 25. The difference. What will that 25 be? Can somebody check as I continue marking? What is that 25? That 25, what could it be? That one you should have gotten. Intangible, you should have gotten. Property had a lot of issues. This other investment you should get. Examiner only requires 10 ticks. So this is 1, 2, 3, 4, 5, 6, 7, 8. So without much stories, you're supposed to get 16/20. That is not bad. We have that variation of 25. What could it be? What could did we add? No. What could that be? You can maybe check. There is that 25 between the assets because this is 43,011. This is 43,18,011. What could it be? Which was not captured. But if it is not there, I will not even disturb myself. Or unless the other investments, maybe check other investments. Check other investments. Maybe that is where there is an issue. Check other investments. It is in which working 8, this one. Other investments, if I'm assume the loan was not captured under other investments, it was not under the other investments. If I delete that, then other investments will go to 85,000. So if it goes to other investments goes to 85, then we are in order. Maybe it is that. But we have worked with 2 assumptions, the shillings 8 and also the UPI. We also assumed 50 over 150. So maybe other investments is the one which was not part, the loan was not part of other investment. We have just assumed. Then this is the correct position. So 43. But ideally, you are supposed to get those 8 ticks without struggling. Without struggling. Even this one you should get, this loan, the 10% loan, this one you're supposed to get. In fact, your marks should be 18. You should get 18/20. That way. So that is how that question should be solved. Before you log out, what else do you require from me? Kindly, chap, somebody. What do you require from me? Kindly, so that I can be able to know. What do you require from me? Let's agree before we log out. What else do you require from me? Is that sufficient or you want me to continue? Not today, but maybe tomorrow and Wednesday. Is there something you want me to take you through? Joyce, Steve, Jared? Kindly communicate there.
Yeah, I think we'll look at what we need
Joyce,
throughout
my
the day. Then
voice
we
I
can
think
write.
has a problem, so just chat. Joy?
Okay.
I'm waiting. Or you are good. Steve. Yeah, go through the consolidation you revert. But if you so wish, I can take you through the consolidated P&L. They have never examined. I can get question from advanced FR, just one. Then we go through. Then I can look also for one question in auditing. In audit, we discuss then niachane na nyinyi hivyo. So the way you have said you will revert, kindly do so. If need be, we go through P&L, one question. Then Wednesday we do, we go through one question in auditing. Then that is all. Otherwise, have a nice day. Continue checking that question. Thank you. Have a nice day.